Hi guys. Today I'm here to speak about the article on Forbes called as Mastering Balance Sheet Analysis for M&A. So this article talks focuses and talks about the importance of balance sheet interpretation and how it is important to demystify the balance sheet for a successful merger and acquisition. Now, the first thing which it speaks about when it says demystifying is to first comprehend to do a to, the first thing is to do a comprehensive asset evaluation where the assets as we know are cash and non-cash. The cash assets, the accuracy of the report of the cash balances through the bank statement and and other reconciliations, assess the liquidity to see if it has the ability to meet its short-term debt is very important, because if the company is not cash rich, that means that it is struggling on the working capital part of it, and it doesn't have enough to pay off the short-term debt which it has taken. The second thing which comes here is the accounts receivable. Is the uh, is the company having any concentration risk, or that means that it doesn't have dependency on on a specific customer who is giving business every month, which is showing on the balance sheet for the working capital and to give salaries and to meet all the operative expenses as well. Uh, the third thing, which is to find out that the inventory and the accounting of the inventory, to check the quality and the quantity of the inventory with its turnover rates, and to check is there any obsolete inventory which has been there in the inventory for a long time which has not been sold. This shows us that how important is it to see the cash aspects, the cash assets of the particular company, and also the non-cash assets here, such as the plant, property, equipment, to check the age, condition, and the maintenance records of the physical assets, to evaluate the depreciation methods, its useful life for the consideration accounts which it's shown in the balance sheet, to see if the depreciation is what type of depreciation has been applied over here on a accounting way, a straight line one or a step one, and to check if what is the actual life of that particular asset, of that particular non non-cash non-current asset, which it shows that okay, it's livable for, this machinery is livable for 5 years, or it's a piece of land. It's very important for a successful M&A, so that there's no confusion at the end of the M&A, and that it has been a fraud. Apart from the non-cash and cash assets, the thing which is more important here is the liabilities. What are the liabilities the company has before the merger? What are the current liabilities, the accounts payable, the short-term debt, the long-term debt, the borrowed money, and the deferred tax liabilities? Let's be sure that in a merger and acquisition condition, the company does not want to, you know, be responsible for the liabilities of the company on the back, on which has taken before, such as say any lawsuit which has been filed against that company, and therefore it's going bankrupt. And it's really very important that these things are taken into consideration, and uh, before moving forward and taking out the the actual value of the company. One more thing which is very important, as we have spoken earlier in the class, is the intangible assets. To we have to The evaluator has to investigate the valuation of the intangible asset, the amortization method which has been used, the useful life of this intangible asset, and such as the goodwill which has been given to the particular company, the patents and the trademarks issued. What is the useful life of this particular uh, intangible asset? Now, moving forward, uh, when there's a M&A situation, as we all know, the analyzing the shareholders' equity is also a very important matter. And the ratio analysis can be done here for a deeper insights of the liquidity of the company, the solvency of the company, the profitability of the company, and the efficiency of the company. And it's very important to find out if there are any red flags here for as a block for the M&A of the company. Uh, Apart from this, there are multiple off-balance sheet items such as there's an operating lease, there's a liability, there's a special purpose entities which have been given on the balance sheet. The quality of the earning analysis, is the earning sustainable and or is non-recurring uh, what your earning is happening in that particular company, is it even profitable without these particular clients giving business. To see the contingent liability consideration, we have to see the lawsuits, the warrants, the environmental issues which are with the current company, and is it is it able to utilize is working capital properly? Is what is the cash conversion cycle over of that particular company, and ultimately then we can come at the valuation and the deal structure of the particular M&A. And we have to also very carefully analyze what will be the post merger interpretation of the M&A. What if the will this the current manpower, the human resource which is there, will they be hired by the this company, or they will have to be laid off? Will the CEO be a MD or director of this of the new merged company, or will he be given a payout of his shares, or what will happen over here? So the post merger integration and interpretation is also very important when it comes to M&A, and therefore this is how we can connect the demystifying of the balance sheet uh, for a successful M&A, that is merger and acquisition. Thank you. My name is Atharva Vaidya signing off. Thank you so much.